Hi everyone, and welcome back to another simple daily practice drill that you can do to become a better trader. And this one is called spikes. So let's check it out. This is going to be the first of a couple of videos on spikes. I'm going to try and keep them shorter so that you can get to practicing the drill faster. And then my advice would be to build up slowly and add more details as you focus on spikes. They're a really valuable concept, and they were critical in my development as a trader. And this is something I still practice today, so I'm really happy to be sharing this with you. So let's go. First off, what is a spike? Well, a spike is a breakout. And when we look at a breakout, we can usually distinguish it by a couple of characteristics. It can be one very large bar, breaking far beyond the range the price was at. It can be two average size bars or three slightly smaller bars, and so on with 4 and 5, etc. But for this exercise, what we're going to do is focus on 3 consecutive bars. Now, I have a free indicator you can download for TradingView, and you can find the link in the description to this video. You can also find it on my blog, and that's going to highlight it on TradingView. But otherwise, it's pretty easy to find it on any other chart. So you can see on this chart that I have spikes with 3 consecutive bull bars. It's highlighting the 3rd bar of that spike. And you can see spikes with bear bars with red. If you don't have the indicator, then just draw an arrow. Now you have your chart marked up with sets of 3 consecutive spikes. So that was the first part of the drill, to notice 3 consecutive bars. The second part of the drill is to look at how often they have a second leg. So let's look at that now. Did this bull spike going up have a second leg? Yes, it did. Did this bear spike going down have a second leg? Yes, it did. Did this bull spike have a second leg? No. You might argue that the second leg was that bar, but for now, let's just keep it simple. It's not an obvious second leg. What about this spike down? Did that have a second leg? Yes. What about this spike down? Did that have a second leg? Yes, it did. What about this spike down? Did that have a second leg? Yes, it did. What about this spike up? Did that have a second leg? Yeah, it did. Did this spike up have a second leg? Yeah, I think we can say that's a second leg somewhere in there. Did this spike have a second leg? Yes. Did this? Yes. Did this? Yes. Did this? No. Did this one have? Yes. So now you've gone through and marked up the chart, which shows which spikes have second legs. Now let's go back to that chart and have a look at some interesting characteristics. So how many spikes have we got on the chart? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. How many of them got second legs? Well, there were only 2 that didn't. So 3, 4, 5, 6, 7, 8. We had one failure here, which I've circled in yellow, and another failure here. So step 1 of the drill is to practice for yourself the incredibly high probability of a second leg after a spike. So on this particular day, there were 13 out of 15 occasions. So that's part 1. The other side of that is if you are scaling into a position and the other side has a spike, then scaling into that trade is a bad idea. So for myself, if I'm in a position and an opposite spike appears, I immediately exit that position because I want to be flat so that I can benefit from the higher probability of a spike in the new direction. So now that you've seen the incredibly high hit rate of a spike, let's look at what happens when they fail. Because a failure to get a second leg after a strong spike is important. That means something that is low probability just happened. And that means everyone that was trading on the side of high probability is now stuck or holding a losing position. And this forms inflection points. And let's have a look at them on the chart. So on this chart, you can see the 2 yellow circles. There's one up here and one up here. So the next step is to put a line underneath the spike that failed. You can see I've got one here. There was the circle. There's the spike that failed. Here's the circle, and there's the spike that failed. So a bear spike, the line's going to be above the high. For a bull spike, the line is going to be below the low. What I've then done is drawn a measured move of that spike down here and up there. So now we can see that not only do spikes have a high hit rate for a second leg, we can also see when spikes fail, they generally lead to a measured move of that spike. When the high probability thing happens, great, everyone's trading in that direction. But when the low probability thing happens, it usually sets up a much larger move the other way. Let's look at a couple of other examples. Here are all the spikes on the chart. Now here is the chart with the second legs that worked and the second legs that failed. Here, this bull spike up did not have a second leg. It had a stronger bear spike. That bear spike got a second leg, and that was a measured move down. Then we had a bull spike, second leg, bull spike, second leg, bull spike, second leg. Another bull spike that did not have a second leg. This failed. We got a measured move down. This bear spike got a second leg. This bear spike did not. Oops, we went up, broke above, measured move up. This got a second leg. This got a second leg. Now, this brings us to the next part of the drill, which is to notice how often the third or fourth spike in a row fail. Now, let's have a look at some of those examples. Here we can see one spike, two spike, three spike, four, fourth one failed. Here, the fourth spike failed. On this chart, we can see two sets of four spikes. We have four bull spikes here. The fourth one failed. Then we have four bear spikes. 1, 2, 3, 4. The fourth one failed. Here, the fourth spike worked, and that's only because we're counting these dojis in here. The indicator has marked it, but I think a lot of traders would have seen this as a two-legged pullback. 1, 2, and then 3, and then this would be the fourth spike up here. Here again, four bear spikes. 1, 2, 3, 4, and the fourth one failed. Well, that's the end of the first video that I'm making on spikes. I will keep making videos on spikes because this exercise is a foundation to how to trade them in more detail. My name's Tim Fairweather, and thanks very much for watching. It's been Zen Trading Tech.